Making important decisions without understanding the risks involved can turn out to be very costly in the end. And that is especially true when investing in the stock market, where something like an unexpected geopolitical development can wipe out months and potentially even years of stock market gains within a short period of time. The volatility in the S&P TSX Composite Index these past couple weeks is a great example that shows how quickly stock markets can change course. So in this video, I'll talk about 3 major risks to the Canadian stock market in 2026, which I believe have the potential to wipe out gains very quickly. But before I begin, a quick disclaimer that this video is not financial advice. It is simply my personal opinion based on the information I looked at and my understanding of that information. So the first risk on my list is a pullback in the price of metals, especially precious metals like gold and silver. Precious metals like gold, silver and platinum and industrial metals like copper have all seen their prices increase significantly in the past year. The GLD ETF, which tracks the price of gold for example, has gone up by roughly 70%. And SLV ETF, which tracks silver price, has gone up by about 140% in the past year. Strong demand due to central banks buying hundreds of tons of gold, investors buying gold to hedge against geopolitical uncertainty and as a store of value have driven gold price higher, while factors like high industrial demand for silver due to its utility in areas like EVs, solar panels and AI data centers pushed silver prices higher. But when prices rise quickly over a short period of time, that attracts a lot of speculators and leveraged players. This can drive prices even higher and faster in the short term, but can also create the risk of a bubble, and thereby the risk of prices pulling back significantly at some point in time. We saw this happen to some extent in the gold and silver markets these past couple weeks, where prices were seen falling sharply, resulting in panic in the markets. Now, a significant portion of the Canadian stock market consists of metals and mining companies like Alamos Gold, Barrick Mining, Pan American Silver, Teck and more, and so is sensitive to the price of metals like gold and silver. More pullbacks in prices like what was seen recently and extended pullbacks can weigh down significantly on the performance of the Canadian stock market. But even if this risk doesn't materialize this year, the next risk on my list is what I'm predominantly worried about this year, which is the risk of unexpected outcomes from the USMCA review in mid-2026. USMCA is the free trade agreement between the United States, Mexico and Canada, which trade well over $1 trillion worth of goods and services each year. In fact, the trade between the US and Canada alone is so large that in 2024, it was estimated that the goods and services traded between these two countries was over $900 billion. USMCA plays a crucial role in the trade between Canada and the US and is especially critical for industries like auto, energy and agriculture in Canada. This agreement is up for a review in 2026, during which it is expected that a decision will be made by the 3 countries on whether to extend the agreement for another 16 years. Any uncertainty during the review process has the potential to weigh heavily on the Canadian stock market. I think the US has a higher leverage in this review process, being the bigger economy, and things haven't really been going smoothly between the Canadian government and the Trump administration recently. If the 3 countries do not agree to extend the agreement, then the review process can potentially get dragged on. Add to this the risk of unexpected tariffs during the review process to create leverage. The result is uncertainty, which can impact businesses' ability to make efficient decisions, like those related to capital expenditure. This can potentially have a devastating impact on the Canadian stock market in the short term, as many Canadian companies rely heavily on Canada's trade with the US. But that's not all, because the last risk on my list might be a surprising one, which is the risk to the energy sector in Canada if Venezuelan crude oil were to replace Canadian crude in the US market significantly. After the capture of Nicolas Maduro by the US recently, it appears like the plan of the Trump administration is to increase oil production from Venezuela. And if you did not know, Venezuela has the largest proven oil reserves in the world at over 300 billion barrels, while in comparison, Canada has over 160 billion barrels. Venezuelan crude oil, interestingly, is very similar to the Canadian crude oil, and many refineries in the US that are designed to process Canadian crude can process Venezuelan crude comfortably. In fact, Venezuelan crude used to be a major source of crude oil in the US in the 90s, but sanctions, among other factors, resulted in this oil supply from Venezuela to the US to drop significantly. Due to the ongoing situation between the US and Venezuela, Venezuelan oil has the potential to be a major competitor to Canadian oil in the US market, which will possibly put pressure on Canadian crude oil prices if it becomes a reality. As US is the biggest customer for Canadian crude oil, this can have a negative effect on the energy sector stocks in Canada, which are a sizable portion of the Toronto Stock Exchange. So there you go. These are my top 3 risks to Canadian stocks in 2026. But remember, as always, this is not financial advice, and I'm not a financial advisor. There is always risk when buying and selling assets like stocks, ETFs, or crypto, so please do your own research and due diligence before making investment decisions. If you want to get more such informational videos and grow your knowledge, you should subscribe.